Welcome to Subramani. If I told you markets are weird, I would just be echoing the views of a fund manager whom I spoke with, who is of course chasing AUM and unable to improve performance much. Of course, he's a well performing fund manager, and largely what worries me is countries which are not doing well. Pakistan is in a debt crisis, Sri Lanka is in a debt crisis. It's not that it is doing too well, but their stock markets are not down. In fact, I think the Sri Lankan market is up by almost 40% at least. Karachi Stock Exchange should be in negative territory. It's not so bad. China hurt its best companies very badly, so there should be a higher risk premium in China. That's not happening. Chinese market is up. India, I'm worried about the way RBI is looking at inflation. It could perhaps be correct, but I am worried because I look at inflation hurting my portfolio very, very differently than what RBI is looking at. RBI is refusing to increase interest rates, but the market will keep increasing interest rates, right? So what has happened to me is the risk premium. The risk premium which you are willing to pay starts from knowing how much is the risk cost of the risk-free assets. So if I keep my money in a treasury bill in the US, or whether I keep my money in a treasury bill in India, which is a 90-day treasury bill, what is the rate of interest I get? That is the risk-free return. Now, if you take the risk-free return in US, it is still at a rate much less than the number of the inflation number that they have accepted. Same thing in India, because I think the inflation in India, at least as it hits me, is more like 7-8%, and risk-free return is at 3%, 3.5%. That is, and I have no clue when risk-free return is so low. What is risk-free return? Because the risk-free return, obviously, it's a short-term return. It does not even take inflation into account. So the inflation risk is not taken into account because it's 90 days. And even if there is a change in the interest rate, it won't impact much because the duration is less. If it was a 30-year duration, obviously the impact would be more. Just imagine what happened to the bond holders in the people holding to Russian bonds. What would have happened to them? Companies which were managing Russian assets have just gone through the roof because of US sanctions. So how is that fully priced in, or is it a good time to be entering the markets and saying, okay, let me buy Russian bonds or let me buy Russian shares, because I know in 3 months, 4 months, 6 months, whatever, market will come back, interest rates will be more rational, and if the war is finished, then I would have made a fantastic killing in buying Russian bonds. I don't know. I really don't know whether to do that kind of stuff. To know whether the risk and markets have got disconnected, if that has happened, it is time for you to worry because the connection is at the hip, right? So they are always together. So if you think that there is disconnection, it means pricing of both the risk and the non-risk is wrong. When you know it is wrong, better to stay safe. Don't worry about inflation and things like that. Even if you can preserve your cash in cash, which means like a liquid fund or a bank fixed deposit or savings bank account, it may not be too bad, because simply because you don't know whether the risk has been fully priced, and the job of the financial markets is to make sure that it picks up risk and price and attaches, right? So when you are looking at return, you are looking at return and you're also looking at risk. They're either side of the same coin. If you are unable to find the price of risk, how will you know the price at which you are buying the share, whether it is worth it? Suppose inflation in India is going to be only 5%, then what is so bad about getting 7-8% in an equity fund? Why do you want 42% return in an equity fund? I don't want. So I'm happy to buy shares which will give me a 5-6% dividend yield and 6-7% growth. That's fantastic, because it means about 11-12% return, and I'm assuming about 10% tax. So about 10% return. 10% return is fantastic if inflation is 5%. But if inflation is 9%, then I want at least 12% return post tax, so that I get some premium for the risk that I take. But that is again, the question is, how much is the risk that I am taking? How much is the premium that I am seeking? Simply because I think risk has been priced very badly by the Fed and RBI, etc. So if you don't understanding risk pricing, it's very difficult to understand whether the share is fully priced, overpriced, underpriced, whether it can go up or down. So I think pricing of risk to me is the biggest worry in the market. Apart from other things, of course, like commodity prices are too high, too low, or whatever. If commodity prices are too high, what happens to the downstream industry? What happens to Boeing and what happens to Airbus if aluminum prices keep going up by 10% every week or every month, right? So this is the latest problem, so that I'm talking about. But I'm saying, when you don't understand equity pricing simply because risk pricing has been taken for, is out of whack, how do you deal with it? That's a very important question to answer. So when risk is not priced, I don't understand how risk is being priced, the worry is maybe all these prices will be okay if there is very high growth and all that happening. But I'm worried about another thing. I'm worried about many of today's investors who are youngsters may not be prepared for a market fall. For example, if Asian Paints falls 15% or something, to some extent people say, oh, petrol prices are rising, so therefore paint margins will go down, therefore the prices fallen. But at 20% will 15%, will people panic and sell the Asian Paints they have, or will they buy more? What will they do? That is something which is not known. Nobody understands that, right? So it looks like if there are more number of people coming into the market, more number of people will go and buy Asian Paints, because they've said, oh, last so many years it has given such a return and blah blah blah. There's so many people talking about it. Or an ITC or an HDFC Limited or an HDFC Bank, and there might be tons of money to be made sitting completely outside these companies. You don't even have to look at these companies, maybe, right? So maybe tomorrow's industry is something else and these companies will not matter at all, or these companies will give you market related returns, but there could be some which could give you 2x, 3x, 4x the kind of return. So what do you do? Very difficult to say. What will happen to crypto? Well, I think if there is panic, Russia-Ukraine war, crypto will fall. Russia-Ukraine war, gold went down, not up. So where is the correlation? Where is the reversion to the mean? I don't understand, and I also don't understand my own ability to implement all those things. If I see reversion to the mean is going to happen, am I going to dump those assets and come into it? Very difficult. Again, I speak to a couple of people, then somebody tells me, therefore this is a good buy. But at what price do you sell? If you bought Vedanta at 100 and today it's at 400, do you sell? Because it is long-term capital gain, so thoda book kar lete hain. Do you do that? I really don't know. I'm worried that if interest rates go up too fast or the Fed makes changes, interest rate change can be very, very difficult and almost fatal for emerging markets like us. So when we bleed that much, what will we do? And it's easy to say, when there is blood in the street, you should be buying. I've been in the market in 1993. There was blood in the street, but a lot of that blood was mine. So when your own blood is in the market, it is easy to pretend. I don't even remember what I was doing in 1993, except that my income fell by 95%. Hold your breath. Yes, my income from brokerage fell by 95%. That's what I was doing. I was a broker, right? So these kind of things happen. How prepared can you be for a 95% fall in income, right? I can be, simply because I know some part of my income will not fall that much. Some part of my income could fall, right? So when there is nothing happening in the market, training also goes down. That's fine, but my dividends won't go down so badly. My Vedanta and JSW will continue to pay dividends even if metal prices are not so lucrative, right? Hopefully they would have built in a buffer. Maybe I would have sold it and bought TCS and I would make money. So it's for me it is different. See how prepared are you for a dramatic change in interest rates, for fall in the rupee vis-a-vis the dollar, or even a rise. If you have invested abroad, it will do well for you. It will hurt if you have not invested enough abroad. So inflation, runaway inflation in the US being exported to the world, you have to be worried about all those things. Not that you need to do something, but be ready for a longish bear market if some of these things were to happen. Sorry for sounding so morbid, but we need to be prepared. That's all. I'm not even saying that there is a recession happening down the corner. Maybe it is, maybe it is not. I don't have the ability to see it. इतनी औकात नहीं है. Thank you.